Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Hey, thanks for joining us. I'm Lance with Real Estate Risk Report. So today's show, we're going to cover our first fraud case, which should be interesting. This is a recent case that has come through. I found on the SEC's website, so you can go check it out and read all the gory details. But I'll give you sort of the high-level view of who these folks were and how it went down, and kind of cover ways in which this particular situation could have been avoided, and people could have lost all their money. So I think the interesting thing I did, and I like this as a tool, right, is I went to the Wayback Machine. You can go on Google and kind of type that in, and there's a web service where you can type in any sort of domain and go backwards and see what that website of particular website looked like, in the past. And so I just did a quick search, went back to, some version of this particular real estate investment management group's website in 2017. And so just to sort of start out, when you think about it, right, like how these things happen, and I'll get into the details here in a minute, but it's very interesting. The first section I kind of found on their website was, written for, hey, if you're interested in investing, website looked nice and very professional. And it said, investors have received checks 100% on time and as obligated for over 33 years. Right. So right there, you've got, they're literally publicly declaring that we always give people money on time. Now, if you go to most other websites, you probably will never find a statement like that, but when you do read it, and especially when everything looks really professional, it sounds like, hey, this is super legit. They keep hitting home on the fact that they've been in business for over 33 years. So the next line says something to the effect of, 10% returns for over 33 years, good times and bad, right? And there you see the same sort of thing, is that, 10% is a really, really good return, and some might think it's too good to be true, but, for many others, they feel like that's sort of really, really solid. And it's, I always call 10 sort of the magic number. Once you get to that double digits, for whatever reason, investors, it kind of perks their ears up. So not surprising that they've used that. Next line, they claim that these are very safe and reliable investments. And we'll find out here in a few minutes that they were anything but that. And then another line, which is interesting, right? They hit on the fact that it's an experienced staff. The investment, accounting, and property management all have very professional resumes. So, one of the things that I've really hit home on is sort of the various roles that a sponsor plays and the service provider should be playing. And I think the big ones are asset acquisition, asset management, capital management, fundraising, the capitalization of these things. Obviously accounting, property management or loan servicing, and tax and things like that. So it's very interesting that they kind of point that out. And I think they're trying to say, hey, we're competent across the board. Now, I think the reality of the situation, after you hear this story, you'll realize that they probably had a bunch of people who weren't actually very smart, because if they hired smart people, they would have blown the whistle on this particular operation. Another thing they hit home on, which, this is what's always sad about this, as much of the advice that I give the good guys, as to how to position themselves. You always see these things sort of show up and they're manipulated and used by fraudsters, much the same. Well, because they can be effective, and they really hit home on the fact that they know their market. In this particular case, they operate in Northern California, Nevada, California in particular. And, so then I think it's sort of this thing as investors, we hear that, hey, we really can, we dominate the dojo in this very specific market, and it kind of has that navigator or guide, sort of thing, or what I always refer to the sort of analogy of, the crazy guy or gal who just, goes to garage sales and rummage sales and finds these things that are worth, 100 times more than they paid for them. Right. And they kind of, they're like mavens and it's interesting if you meet someone like that, you'd be like, hey, let me bankroll you. I'll invest in your deal because I want those kind of returns. But we're attracted to those who can gain access to things that we could never gain access to. And so they really played that up, that, they were very, very intimate with this particular market, which is a good tactic, and something I think that you should look out for. And I think is important, but in this case, these guys were crooks. So, and then the other thing, which I think is a red flag, but once again would be innocuous and you'd overlook it, is that the contact person, even after 33 years, and in this case, this particular individual was, he started in 1990 and was sort of the right-hand man to the founder and the other perpetrator, but that's the guy you have to reach out to. Now, in most cases, when people have been in business for that long a time, there's usually someone else that's going to be the front man. In this case, it wasn't, which, I think sometimes can be a red flag. So anyway, let's get to it. High level, what happened, right? So we'll get into the details here, like I said, but ultimately $26 million was misappropriated and is, more or less vanished, from investors, about 1,300 investors. So, a lot of money, they've raised about 330 million in the last 5 years, all the way up into this basically it unraveled, in May of this year when the founder of this operation passed away. And it really, basically completely, imploded in July. So 330 million bucks, that's a lot of money. So really at the heart of it is this one particular individual who, you can look up. I won't name him out loud here, but he basically started as a bookkeeper in 1990. He was promoted to president in 1998. He actually started in the same year that they created, I think the vehicle that ultimately, really was the tipping point of how this scheme went down. And he was, basically in charge from 1998 to 2020. And from the SEC sort of report on this, looks as though he was the main beneficiary of the fraud, but that this particular deceased founder was obviously very much involved and aware of the scheme being perpetrated. So how did they do this, and what did they do? So let's just talk about the structure, because I think that this is where, the more that you listen to this particular podcast or spend any amount of time with me, I'm very much, it to me, it's all about this oversight and monitoring. And sometimes, people think that, I've been asked the question of, hey, if you guys were the administrator, the monitor of Bernie Madoff, would you have busted that scheme? And I'm like, of course we would have. Whoa, that seems audacious, but it's like, at the end of the day, all you need to do is follow the money and follow the assets. And in this case, this is no different. So the structure that they used was that they would buy residential and commercial real estate. They oftentimes would syndicate, the acquisition of a real estate, which is very typical these days, right? You see multifamily syndication, self-storage syndication. The syndication is basically a single asset that, many investors participate in, where there's some sort of preferred return, hurdle rate that the common equity investors earn. In this case, they were usually putting them out at sort of 6 to 9%, which is once again, right down the pipe as one, I think would expect, maybe on the lower end even, but, with the 70-30 or 60-40 split above that. So everything looked, very sort of, legit in what you would expect. Now, in this case, what they had done is they formed another entity called, for the sake of this, was called, PISF Inc. And they used this particular vehicle, served as, as a limited partner, which would invest alongside of these other investors invested into the common equity. Once again, not uncommon. We have many clients at Verivest that, do something very similar. So nothing would look out of order there. So far, very innocuous. But I think that what they did was that at the PISF level, they were issuing notes. So basically, you as an investor could borrow this particular entity money, and they call these things straight notes. And they basically said, hey, invest in this, and we're going to turn around and invest, whatever we get from you into, these individual properties. So basically get exposure to a multitude of assets. Once again, so far, so good. I don't think there's anything wrong with that. And they basically created what amounted to a fixed income, replacement. They basically said, we'll give you monthly payments. So you can receive them in cash or you can reinvest them. Once again, very IRA friendly, the reinvestment option. Monthly is great because you got to eat on a regular basis. And they were doing them at 9 to 12%. So basically they were saying this was sort of what I'd call, and I think for me, this would have been the tip off, right? Like, wow, that's a pretty high coupon rate for what amounts to, I guess it's still within reason. It basically is serving as mezzanine financing, right? So it basically would be senior to the equity down there, which I guess is pretty much in line. And, so that was the deal. So I think, once again, you're like, oh, not too bad, right? But, this is what they did. Now, the last piece that you could participate in, what they call DOT notes, and these were basically fractionalized. They were trust deeds. California's a trust deed state. This is where it happened. Like I said, they would basically lend money. They would create a second or junior mortgage that would be to the, on that particular investment that they made or piece of property. So it's basically, in that case, it was a second lien loan, which is where this is what would sort of tip me off, right? Like, so now we've got, and they must have been selling it as though that was kind of the bank. Like, so people investing in those must have thought that those were sort of like first position loans. And this is where I think it all sorts of falls apart. But I think that's what they were kind of saying to people was like, okay, you invest in the equity. So you get to participate in the upside. You can come in a second position and get a little bit higher coupon, but then you could invest in these DOT notes, which paid out between 6 and 9%. So it's more of like, hey, be the bank. But those were fractionalized and they were basically true assignments or true liens against the property, but a fractionalized position. So if it was, let's say, $400,000, and a bunch of, people put in 50 a piece, they would have a fractionalized, piece of that particular loan, pari passu, equivalent to one another at 6 to 9%. Once again, very attractive, right? Like, but the problem with that is that when you're being sold this, the big issue is that they're basically controlling the entire capital stack, meaning for that piece of commercial property or whatever it was, they basically controlled the common equity, they controlled, the mezz debt, and they controlled the senior debt. And, that means that they basically had full control of the asset. There was no independent party who could, like a bank would be, or a private money lender, and because I've actually suggested a structure like this to one of my advisory clients. I think that, for certain strategies and for people that are doing certain things like on the smaller level, sometimes it makes sense to have your own investment vehicle that might be investing in second position and formulating it as debt, providing monthly payouts, but it also is, having someone in senior position that's not an affiliated entity makes a lot of sense. Because once again, they're going to make darn sure that they're going to get paid back. And if the particular sponsor or the operator is not able to, execute their strategy of, value add strategy or whatever, they're going to be foreclosed on. And, but in this case, no one's in that seat, at least as far as the investors, realize, and if they put it all together. But once again, it's very attractive from the investor's perspective. I'm sure that the sales pitch was very persuasive, and it should be. I can see what they're doing, but once again, what it's lacking is some oversight. So here you have this entity. They were founded. This company is founded in 1983, and they filed BK in July of 2020. And in this case, they had about 70 residential and commercial properties, and they also served as a property manager. So not did they just only control the whole capital stack, they were the property manager too. So they basically controlled everything. And once again, I'm not opposed to sort of vertical integration. I think that vertical integration can be a really, really good thing. In most cases, it is a good thing. Obviously there is conflicts of interest, but it does create efficiency in most cases. But you do have that notion of, how do you really know? You got to pay closer attention. Hence why I always think there's got to be some third party involved that's sort of overseeing, these activities. So let's take a look here. So, ultimately what the scheme, ended up being here, like I said, is $330 million, 1,300 investors are affected. A lot of it was IRA money, which of course makes sense. In this case, that's what people are attracted to, sort of putting in, and borrowing money to some entity, earning interest income and not having it being exposed to sort of taxation, because oftentimes, that's not the most tax efficient investment, but it's great for an IRA. And then for those who, when it was an IRA money, a lot of the investors were retirees, right, who were using it truly as that fixed income replacement so they could pay their bills, right? And so at this point, here it turns out, what did they end up doing with the money? Where did the money go, right? And like I said, since they controlled the whole thing, it opened the door to where bad things can happen. In this case, it does kind of seem like, I'm sure there was some sort of tipping point when they realized that, hey, this sort of works and people are into this, and I can kind of, really pay for this lavish lifestyle, or and do that. So I'm sure they didn't set out necessarily, to be sort of bad dudes, but at some point they realized that, hey, this could be a good gig for us. So what ended up happening, right, is that the main guy, the guy who started as bookkeeper in 1990 and became the president, he basically had full control of all the bank accounts, and he would monitor it daily. And he would basically just, wire money from whatever entity needed to some other entity, and basically just rob Paul to pay Peter, Peter to pay Paul. And then he would book those as sort of intercompany payables accounts, due to from accounts, which, as being kind of the accounting background, once again, this is how I know that the people that worked for them weren't necessarily world beaters intellectually. They probably looked at it like, hey, I'm just booking the entries. It's due to from. It's not like, in accounting, it's unusual to see intercompany accounts. Although us at Verivest, we hone in on that big time. We call them related party transactions, and those are the very accounts that we want to go and look at and say, what in the world is running through that account? Why are you borrowing money from one entity to another? It's not to say that that's not acceptable, but in most cases, it just, that's the first place I look, right? What's going on? So how to use the money? Well, of the $26 million, much of it was used and wired to his personal accounts to pay his credit card bills. He went on lavish vacations. He bought luxury cars. He had a really nice coin collection, I guess. He paid private school tuition. He also invested, of the 26 million, I guess he decided to put 14 million into a failed land development deal in Texas, which, there you go. And also a $2 million investment into a Texas oil and gas exploration deal. So he was sort of in the double down mode. He also happened to buy a $1 million Malibu beach house. Right. So, on the outside looking in, this is sort of that issue, is that, many people, when they see success, they see like, wow, this guy, he drives a nice car, and he, I'm sure he dressed nice, and I'm sure he was, well groomed and well spoken. And I can only imagine. I have no idea. But, sometimes that's the problem, is that we see that, hey, he looks like he's achieved success, therefore he's successful. Therefore, everything else must be hunky dory. I should get in on this because it's a good thing. It's real estate. Real estate's a good investment, yada, yada, yada. But once again, just having a better appreciation of how these deals are capitalized, and those things, is that when you start to unpeel the layers, you realize like, hey, that just doesn't seem like it pencils. So what, a lot of what ended up happening in this case, it is that, investors went into it thinking that they were the ones who were serving as the bank or whatever, but because I'm assuming most of these liens weren't actually recorded, those DOT notes where you felt like it was fractionalized, my guess is those never recorded. So they appeared on the public record as though they were free and clear. So what they ended up doing then was going to, other private money lenders and using those properties as collateral, right, to borrow more money. And, and then I'm assuming that they then just, didn't report that, they probably end up not reporting the investments from that PISF entity, as debt on the balance sheet. Once again, if they had an administrator, someone else external that's preparing the financial statements, they would have caught this. And potentially if they had an auditor, maybe they would have caught it. It's hard to say. Because ultimately these were individual syndicated deals. So that's probably where you typically wouldn't see kind of audits at that level. But the tax preparer probably was none the wiser, right? Whoever did the taxes on these things, and maybe they were done internally, but the tax preparer is probably just going to take financials that look legitimate, like it looks like it makes sense, and wouldn't have necessarily picked up on those things. So that's and then sort of the last thing, like the misrepresentation. So with this whole COVID-19 thing happened, obviously this founder died in March or something, which sort of triggered this whole inquiry, but that plus the pandemic. So this particular guy who was running the joint and was misappropriating the money, he basically told investors that he could, hey, we could liquidate your notes in a matter of a couple of weeks if we need to, no big deal. Hey, we're in a super strong financial position. He's saying these things like this year. He sent an email to them in March stating that, hey, these assets are performing exactly as they were meant to. We have sufficient cash reserves. We have access to lines of credit. There's no sort of negative effects from COVID, which none of it was true, right? They had no access. They had no lines of credit. They had no cash reserves. These things were, clearly upside down. And then he went as far as kind of posting some, which I was unable to find because the website's taken down, but basically posting this stuff on the website as well. And my hunch is he was attempting to, they needed to continue to fuel the machine and get more people. They didn't need people that were, panicking and worried, which of course investors tend to do when things like a pandemic strike. And then he went even as far as to tell investors that, hey, we have property that are free and clear. Of course, they had none that were free and clear, which they could sell if they had to. And, the whole thing was a sham. So, this is the sort of thing we're going to do more. This is just interesting because this was sort of a very recent one. And, I just read through the thing and kind of did a little digging, but you can just see like, those are the things. And that's why I put together this sort of due diligence checklist. This is why I'm a huge believer, even though it's sort of a biased, opinion, since, I not only believe it, but, we've created an entity to sort of try to solve this problem. But I just think that, you need someone else that's not the people that are watching on an ongoing basis, right? And that may be you as an investor, right? Where my hope is with this podcast, I teach you enough to know what to look for. Once you avoid stupid things like this, which are just clearly, don't make sense if you just, hindsight's 2020, right? But it doesn't make any sense. But you need to know what you're looking at in order to determine that. And then if you do invest in something like this, which once again, like some of these things are really great and they can work, but someone needs to be there to keep people and hold them, keep them honest, right? It's that trust but verify sort of stuff. So that's sort of this initial scheme. There's a couple others I've pulled that I think are interesting and help kind of demonstrate a lot of the things I talk about. So hope you like that. I know I talked really fast. I'll put the link sort of in the show notes. You guys can go and dig through and kind of see all the other gory details that come along with this, but it sort of gives you a sense. So, all right, you take care, and till next time.